Usio Inc., ticker symbol USIO, 2025 quarter one earnings report. I'm excited about this company. I'm really excited about this company. I think Wall Street has it wrong a little bit. I don't think they are wrong in their assumptions about the company, just how the market works. But I think they are missing an opportunity, which is my opportunity, an our edge for the people in the company, right? And so I already listened to the earnings call report a couple times, looked at the transcript, look at the filings, and so we'll just go over some of these notes of what I have about the company, and we'll go from there. But overall, long-term bullish. I actually like the direction of where the company is going. I like the CEO. I like their ideas. They make money. These are one of my plays that I am super comfortable holding. So when we look at quarter one 2025 revenues, they had 22 million in revs. They have a great relationship with MasterCard, and I want to bring up that's why you need to watch this interview in good company at the Norge Fund with Michael Maybach, CEO of MasterCard. You'll understand why Lewis is going a certain direction once you watch that interview, right? When he's talking about biometrics, when he's talking about where he sees the world going, it's because of Michael. It's because of their relationship and the opportunity at hand. Growth expected to ramp up in Q3 and Q4. ACH is still the workhouse for the company. It's the best driver of money. Sales pipeline is strong, especially for PayFac. And they're just focused on the small to medium business market, which I like because there's other companies I'm invested in that are similar, but they have a different level of commerce, a business they're dealing with. And since we're talking about the payment facilitation phase, the payment processing industry, in a lot of ways, it's the distribution industry. And I want to get into it in a later presentation where I really feel like there's really no difference between a beverage distribution company, a payment processing company, and a railroad company. And I'm going to give reasons why later. But payment processing, really, if you think about it, it's just the transfer of money on virtual train tracks, right? Getting to point A to point B as easy and efficient as possible. And that's no different than the railroad industry when it came up, right? Before the railroad industry, you had boats, you had buggies to get things across America. You had the rivers, then you had the buggies. So you would use the Mississippi River to get to a certain point on boat via water. Then you'd have to take the rest of the way with carriage. Then now bring in the railroad where it's a lot quicker, right? Where it might be a little bit more expensive, but regionally, say if you have coal in one region, they need to get coal in another region. Instead of taking the Mississippi, then carriage to get there, you just take a straight shot, boom, with the railroad, right? And so you have to think about that in payment processing terms as well. How hard does it is to get paid sometimes? How, it's been getting better, but think about it. Sometimes you get paid a certain way, check, cash, or a different method. Then you have to put it into a system. Then you have to put into another system to get it to the end location of where you want it. And so that's why the payment processing industry is very important. It's in its young phases, but there's going to be a lot of winners, in my opinion. And I have a lot of investment in this. But small to business market, another company I'm invested in is SoFi, and they have a payment processing branch, Galileo. But they're dealing with bigger banks, loans, businesses, and such. They're not worried about this market, which is why I'm comfortable in investing, because they're not dealing with the same type of competition. And so my investment in Usio right now, I have 1,000 shares, almost over 1,500 in dollar amount, down 11% right now. My average cost is 1.3, but $1.43. So overall, I'm okay with that. So the book value, so you're taking the shareholder equity with the shares outstanding. They have a book value of 18.9 million, almost 19 million. You divide that by the shares outstanding of 30 million, we're looking at 64-cent book value. But remember, this is a tech company. This is a fintech company. They're very capital light. And so while I like looking at this, and they do have some physical assets, this is really like the base bare bottom, right? And I don't think it would ever get this low because of the money they make revenue wise. And so if you take their 2025 linear guidance, not what they said they'll do, but what they're on track to do quarter to quarter, they're going to be sitting at 88 million in revenue, right? So you take the 22 million times 4, you get 88. You divide that by the 30 million shares outstanding, you're looking at a share price of $2.93. So in the linear case, if they don't exponentially grow at all, if they don't hit their expected revenue guidance numbers, you're looking at a price of almost $3, which would be a double from here in very conservative terms, right? And yeah, there's another thing I brought up before. They recouped all the revenue they got from like that one-off COVID deal they did during COVID. So they're back on track of where they were before. Now you're looking at what they were expecting revenue growth. They're thinking 16%. So, okay, we had 83 million in revenue in 2024. You have the expected revenue guidance of 16%. So you take the 83 million times 60%, you're looking at $96 million at the end of 2025. That's what they're shooting for. And that's what they're saying where the growth is going to come in Q3 and Q4. It's going to be a little bit slower of the burn for the first half of the year. But if they hit their guidance of 16% and we hit that 96 million, we're looking at a share price of $3.21, right? And that's bare bones. That's just looking out for the year. Some people look at it on a 5-year basis. What should the company be trading on a 5-year expected revenue basis? Some people value like that. I don't, especially I don't when it comes to when I'm in a buying phase, right? I'm buying the stock. I'm a value investor that focuses on growth, right? So I'm trying to get the best value possible. I'm trying to buy at value prices for growth companies. So that's why I'm buying at under 150, because I see a built-in double, at least a built-in double. It might not happen overnight, but when you look at the valuations, that's what I see, and I think it's a pretty safe bet. When you look at the 52-week low, it's $1.25. So we're sitting at really close to low, and we're looking at the historic lows too. So I think it's a really safe bet in that case for Usio. Let's look at some of the revenues before you get to gematria. So the 3 months ended in March 31st, revenue. So yeah. Let's see where the money comes. Output Solutions doing a great job. Doing a great job with money. 5 million from Output Solutions. ACH, another 5. Credit card, 7. So we have some heavy drivers of business. The ACH, credit card, Output Solutions. So we're kind of hitting in all scenarios right now, which is good. They're doing a share buyback as well. I was a little confused on how much the money they put into the share buyback. I know they authorized another 4 million. I think they spent 1.5 million on share buybacks thus far. The total number of shares purchased, they said, is 217,000 shares. So that's what they spent on thus far. I could be wrong on the numbers, but I know they're buying shares. And that's because they have a positive cash flow, which is nice. And that's kind of where I've been with the progression myself as an investor. Invest in companies that already have a positive cash flow, that are already making profit, and you will take the gamble on if they can grow, like if they can find those growth drivers, right? And so that's what I'm taking a gamble on. I'm not taking the gamble on if they can run a good business. They are running a good business. I'm taking the gamble on if they can make this a great business. They can make this a growth driving business in the fintech space. That's my gamble. That's the edge. While everybody's, Robinhood, even SoFi, I'm investing in SoFi, even SoFi and all these other fintechs that they're a part of, they're missing out on this one because they don't see the growth. When there's tech investors out there, growth investors balking at 25%. There's investors out there that if they don't have 25% in year-over-year growth, they're not investing. I personally don't subscribe to that. And I feel like a 16% revenue guidance is strong and you can make a lot of money over the long term. Obviously, I want higher, but if we're getting that growth, is the bottom line coming up as well, right? And that's the important thing. So I'm really excited for this company. So let's talk about some gematria we have for this, and we have some strong gematria as well. And so we'll start with this one. Payment processing, a longer tail. And you will see it across the industry. The payment processing industry was going through a rough patch in 2024. A lot of the companies weren't doing well. And it's just because when you go back to the distribution model of things, it takes a lot longer for clients to get on board. But on the back end, it takes a lot longer for clients to get hop off. And so when you gain a client, it could take a year or so to get them all integrated. But when you lose a client, it's the same thing. It could take a year or so to get them off. So that has its positives and negatives. And so it's a longer tail. But if you do a good job and your clients don't want to leave you because you have a great product, you'll have predictable income for years in the future. Because a lot of times, once you're set up infrastructurally, you don't want to move, right? It takes too much energy to move off once you get ingrained into a system. So that's why it's a longer tail, and that's why sometimes it can be slower growth. Payment processing, a longer tail, the strong 333 ordinal, 135 reduction, and 153 reverse reduction. Then we have PayFac. PayFac is a distribution industry equaling 137 reduction, 187 reverse reduction. We also have biometrics added to Usio's PayFac plan, which they're trying to do. 137 reduction, 187 reverse reduction. You see the connection there. And we have biometrics payment, Usio growth, 137 reduction. We understand 137 is the 33rd prime. And Lewis in the conference call, make sure you watch the conference call, listen to the conference call. He's really excited on the biometrics. He says, the company is profitable. We have a share buyback plan. We have 16% revenue guidance coming in, and we're expecting growth. So now what's the next step? Where's that driver going to be? Biometrics. And he got that from the MasterCard CEO. I'm sure they've had some type of conversation about it. I'm not saying they've had it one-to-one, but it might have been like a business presentation where the CEO talked about where they're going, where credit cards want to go with biometrics. And so if a company like Usio or anybody else can get a biometrics project up and is successful within the next 5 to 10 years, that could be a good buyout opportunity for the company. So that could be interesting, even though I'm not invested because of that. That's just kind of a icing sprinkle on top. Usio working with MA on payment, 133 reduction, 137 reverse reduction. Payment processing companies are the new railroad companies in modern society. 333 English reduction. Come on now. You think I'm just making all this up? I back test, I think about this, I meditate about this a lot. And so I want to say this again. Payment processing companies are the new railroad companies in modern society. 333 reduction, right? Railroads in the 1800s, after the Civil War into the 1900s, they transported everything in America, and it was a huge industry. People made a lot of money. The steel industry made a lot of money because they had to refurbish the iron rails with steel. Like, the rail industry was a major industry in America, and there's a good case to say it wasn't the best option if America focused on water transportation in general on a per cost basis. But regardless, there's a lot of similarities between payment processing and the railroads. And I brought it up before. You streamline everything. There's going to be a day and age where we streamline money so much. It could be via biometrics. It could be via something else where, everything, our whole net worth could be on us, at 1 second at any time. And it could be safely transferred to any institution or anything at any time. We're not there yet. There's a lot of different things you do. Obviously you have a debit card or a credit card, you have your money on it, transfer over there, you buy something. And so there's still some phases that need to be condensed in, but that's where it's going. And we have Usio growing with biometrics, 330 in English ordinal. You cast off the 0, that's 33. So this is what I have on Usio. I'm very excited about this company. I recently added shares to get to 1,000 shares overall, and I'm happily holding for the long term. I think they have a good plan in place. I think they're severely undervalued. And that one Litchfield Reserve research fund, they still have a buy target of 6. So they're obviously looking at it towards, in a forward rolling basis, more so than I am. Their buy rating of 6 is double what I'm expecting revenues based off our outstanding shares. So we'll see where things go. And we'll monitor accordingly. But if you're not in this, I think this is a good play. But I'm not a financial advisor. So all Usio shareholders, if you like this video, make sure you subscribe to all my channels, and the links in the description pinned. If you have any questions, make sure you leave a comment. And moving forward, stay on the lookout for some more videos. But hopefully you got some value in this one.